everything we love is now at risk. Danger is no longer on the horizon. It has arrived with a fury. We are facing one of the gravest challenges of our lives. Do we give up? Or do we fight back? FIU has assembled one of the largest teams in the nation. The expertise, the capacity, the people who will make a difference. FIU searches for solutions, not problems.
We now have a national testing facility, so now all wind engineering projects from around the nation will come here.
Public health and the environment, it's all interconnected.
FIU leads the charge to protect and preserve.
In the past few years, we've reversed the fate of many species that were on a path to extinction.
Everybody! And FIU is blazing a path into a sustainable future.
The world really does look at FIU as a model of how to move forward with conservation and restoration.
It doesn't fall to somebody else. It's not another person's duty. It's not another generation's responsibility. It's ours.
Hello, welcome everybody. Thank you all for joining us here at Florida International University and our platform in Washington, DC. It's a pleasure to have you all here. Today's event is going to look at a very serious challenge that we are facing with catastrophic wind and flood insurance and climate change and affected communities from Florida to all across the country. I just want to remind you before we get started to please mute your microphone and cameras unless you're actively speaking. And if you would like to make a comment or ask a question, please drop it in the chat and we will be looking at that. We've hosted this event that we're trying to bring national attention to an issue that Floridians are on the front lines of, but that is could be coming to a neighborhood near you soon. Florida has been on the front lines of environmental risk for a long time. Floridians have been uniquely exposed to catastrophic storm damage, now rising seas, more severe storms, a fast-growing population have only increased the risk that Florida's families and businesses are exposed to. So even though Florida has achieved an incredibly favorable climate for business and for Florida's families to flourish, it's facing, recent reports warn that there could be dramatically increasing insurance rates and decreasing property values and major fiscal challenges to the state. These are problems that affect many areas of the country. And as we face these problems, we face them on the flood risk side within the framework of the National Flood Insurance Program, which is a program that in many ways subsidizes development and subsidizes flood insurance. But as, under the framework of this program, private insurers have largely exited the market, at least in Florida. And so as we get further and further away from a real market-based rational pricing of these insurance premiums, we're getting disconnected from what the data are actually telling us about what these risks are. This is something that one of our panelists, Professor Shahid Hamid, who runs the wind hazard models for the state of Florida, is intimately familiar with. The key thing that we want is to be able to apply financial models and mathematical models to get as precise a picture of what the environmental data are actually telling us. And so reports warn that insurance may rise in the years ahead, wind hazard insurance and flood insurance, but by how much? How much would insurance rates need to rise? How much will property prices be hit? How big is the potential hit to the state budget? And those are key questions, because if the insurance is currently underpriced, the solution can't be overpriced insurance. And the current framework that we have has a great potential to leave us with insurance that is overpriced. For example, under the current framework, there are a few ways for people who have flood insurance to bring their premiums down by doing the kinds of mitigations like raising your house, or for the community to enhance its pump system for flooding. There are a few ways for these mitigation measures to bring premiums down. So that is why Florida International University is tackling this issue along with similar issues across the whole array of financial and environmental interactions. We have at Florida International University, we've developed the Environmental Finance and Risk Management Program to apply the most advanced financial and risk modeling with the most advanced environmental data and forecasting using big data analytics and the most modern artificial intelligence that we can have access to give us the most granular, most accurate, and most precise understanding of what these various data sets are telling us. And so with that, I'd like to introduce the first of our speakers, Phillip Rosetti, who's a resident senior fellow at R Street. Phillip will talk about his work, and then we will go to a panel discussion. Phillip is now at R Street. Prior to joining R Street, he was a fellow on the minority staff of the Select Committee, the Congressional Select Committee on the Climate Crisis. He has a master's from the Whitehead School of Diplomacy at Seton Hall and a bachelor's in political science from the University of New Mexico. Phillip, thank you for joining us.
Thank you for having me. And that was a great introduction. And Mario, I really appreciate everything you mentioned about the business community and that's importance to a state that's also facing environmental vulnerability like Florida, because that's exactly what we want to talk about here. So, I am, really just going to be kind of introducing the topic because you all have some great panelists today that are intimately familiar with this topic, more so than I. But there are three things I want everyone to kind of think about as they're, thinking about flood insurance and environmental risk. The first is kind of the philosophy of how should we be thinking about environmental risk as it relates to our economic risk or public policy, and what does that mean for us? The second is, what is the role of insurance markets in mitigating that risk? And why do we actually want healthy insurance markets? Why is it a bad thing if insurance markets are subsidized? Because a lot of people think, usually that's a good thing if you're sort of stimulating more activity, but sometimes it can be bad if you don't have good information about risk. And the third thing are, what are the public policy tools that we should be considering and things we should be doing at the federal level or perhaps even the state level to make our risk profile better and actually have a better calibrated economy that is more cognizant of the risks. So on kind of the first point, I don't think it's a surprise to anyone that we're expecting generally the costs of hurricanes and storm-related flooding to increase. There's that great intro video which really highlighted, kind of the visual impacts of what happens when we see these disasters strike. And the Congressional Budget Office, which is a nonpartisan economic institute that advises the U.S. Congress on economic impacts of their policies, estimates that increase in storm damage is going to go up by 33% between now and 2075. And currently we're about $54 billion in average annual economic impact from hurricanes and storm-related flooding, which is a lot. But importantly, the context, we're also a $20 trillion economy. So we want to make sure that our policy response is calibrated to the risk that we're trying to mitigate. Now, when most people hear the cost is going up, the first thing that they usually think about is the climate impact on that, and climate change driving up those costs, and that is often used as a justification for further climate policy. But the reality is a bit more complicated, because the CBO noted that most of the increased cost in their estimate actually comes from private sector development in high hazard areas. One thing to know is that the CBO is relatively conservative in its estimates of climate impact. So there could be other studies that are going to show that it's more climate than private sector development. But the key thing to note here is that just on as a facet of people getting wealthier, having more value, and really wanting to live in these beautiful coastal properties, that's driving up cost. So regardless of where someone lands on an issue like climate change or how they feel about climate policy, there is a public policy impetus for getting better on these issues, because you're not gonna bring down the cost if you're only focused on the climate issue. And then in the climate vein, it's important to keep in mind that we're talking about a global collective action problem with long-lived pollutants. So we have pretty limited ability to reduce our environmental risk from hurricanes and sort of the economic impact of that through only climate policy, because it's one, very difficult to do globally, and two, it's going to take a long time to kind of steer the ship in a new direction. So we really need to be thinking about what are the things that we can do in the United States in terms of adaptation and better pricing and risk signals that inform better decisions and more efficient outcomes. And that brings us into the role of insurance markets. So traditionally, everyone here responds to prices in some shape or form. Whether that's choosing what cereal to buy or what car to buy, you all are going to make trade-offs in your daily lives about how much you're willing to spend relative to the economic utility that you're getting out of something. That's just kind of a function of life, unless you're so fabulously wealthy that prices have no bearing on you. In which case, I commend you for joining us this morning, because you could be doing other things also if you have that much money. But that's kind of what guides us all, is price signals. Insurance markets are important because they communicate the price of risk to us. So you think about car insurance. Now, if you are a reckless driver, if you are speeding, if you're running red lights, you're going to be paying more for your insurance. Conversely, you always see these commercials say like, oh, you get a safe driver discount or whatnot, and they're trying to give you a price signal to be a lower risk driver, because the insurance market is going to operate better if the overall level of risk in its insured pool is lower. And they want to communicate those incentives for people to lower their risk, because that's how the insurance company is going to remain solvent, and it's going to also maximize its sort of profitability. But you want the insurance market to remain solvent, because if it's not, you can't get insurance. Now, the problem we kind of face in the environmental risk issue, especially when we think about hurricanes and storm-related flooding, is that the National Flood Insurance Program doesn't operate the way that a private insurance market really would be expected to. Mario pointed out that it's pretty widely subsidized. There are about 5 million policyholders, and it's subsidized by about $1.5 billion per year. Most of those subsidies are things like grandfathered rates. There are these sort of caps on how fast the rates increase. Even when people can create new construction, they're still eligible for these grandfathered rates and these lower premiums, and they actually accrue more value. But the policy cost does not actually rise with the level of risk and also the property value the way that we would expect it to. As a government program, the Nfip, which has a monopoly on flood insurance in the United States, doesn't have incentives for economically optimal outcomes. It really is just fulfilling the statutory obligations of the program. And the Nfip originally was actually supposed to reduce risk by making flood insurance more widely available where it previously wasn't. But it's kind of gotten away from us because as it's created these subsidies, it is also eroding the price signals that are important for us to understand risk. And Mario mentioned, a lot of business development and economic growth in Florida, which is a fantastic thing. But it's also important for these businesses to know what is the level of risk that they're entailing, because they don't want to be in a position where they're undertaking more risk than is communicated to them by the prices. And having that price signal is just absent from the NFIP owner's current framework. Now, normally we would expect that these policies are really subsidizing low-income households, or there's some sort of policy impetus where we're saying, hey, we're willing to pay that higher cost to actually affect this outcome that we want, which is access to flood insurance for everyone. Instead, what we're seeing with the NFIP specifically is that most of the policyholders are actually high income. This is because those are the households that are usually most able to afford coastal property. There was in 2012 a reform to the NFIP, which essentially eliminated 438,000 policies that were subsidized, and 350,000 of those were for second homes. So this is not a program where we're really mostly going to low-income households. It's most of the benefits are going to high-income households, and importantly, it's not even across the NFIP. So the coastal properties get the subsidies, and then the more inland properties under the NFIP actually pay higher rates than they otherwise would. So it's not really a well-calibrated system. So the NFIP is noble in its intent, and we certainly applaud the need to make sure that we have programs that ensure access to flood insurance, but we do want to ensure that everyone participating in the market knows what the risk is, because if they don't have that price signal, they're going to put themselves and their property in harm's way, when otherwise they would get a price signal that says, hey, it costs you a lot to live here. Importantly, if you have that price signal, as Mario pointed out, you're probably going to take measures to reduce your risk. You're going to raise your home. It might be just raising electrical outlets in your home to reduce flood risk. There are a number of things that someone can do, but if you don't have a program that is well calibrated to level risk, you don't have that incentive to undertake that resilience improvement. So this brings us to the kind of the final point, which is, how should we be thinking about public policy in this space? What should we be doing? Well, probably the first thing to think about is ending the grandfathered rates, especially for new construction and homes that have or businesses that have received substantial improvements. So about 85% of policyholders in Zone V under the NFIP, which is the highest hazard area, have subsidized rates. So basically everyone in those areas has a subsidized rate. So we probably should not be continuing to subsidize those rates if we want to actually have good price signals. Another thing we should be thinking about, and probably the most important thing, is actually getting better information to the NFIP. So the flood maps, for which the NFIP is supposed to base its premiums off of, are supposed to be updated every 5 years. And currently, or as of 2017, I believe 42% of flood maps were up to date. And we've never broken the 50% barrier for having flood maps up to date. And 2015 was our peak at 49.6% of our flood maps up to date. So without that good information, the NFIP can't really function. So there needs to be better sort of resource allocation and efficiency and actually updating flood maps, and also making sure that they're accurate, because there have been studies that have cast that into doubt. In Chicago, FEMA and their flood maps essentially said that there was 0.3% of the land was in a 100-year floodplain, and then other studies said it was 13% of the property was in a 100-year floodplain. So there is a question about the quality as well. So getting better flood maps is also key. And another thing we should be thinking about is coastal resilience. We spent a lot of money on coastal resilience already, which is something that we want to do in terms of reducing our impacts from these storms and hurricanes. But we also want to make sure that these resources are spent in a way that prioritizes outcomes and the most effective opportunities. Louisiana, which got hit with 5 hurricanes last year, already has a program which prioritizes its resilience efforts and identifies projects that have the most potential benefit. And Louisiana, I think came out less than the sort of hurricane damage that we would normally expect if you're hit with 5 hurricanes in 1 year. It's still bad, it's still devastating, but it speaks to the effectiveness of better coordination of resources. Currently, we have FEMA, we have HUD, we have Army Corps of Engineers, we have all these disparate elements in the federal government, and they're not always unified in identifying the best opportunities for using federal resources to reduce the cost of environmental disasters. So with that, I think that's a perfect segue into our panel, who can speak far more to these issues than I can. But I hope that you all are thinking about, what is the role of insurance markets, and why is actually a good thing for risk to be well understood and to communicate that risk to individuals, and that we don't want to just have a continued sort of program that subsidizes policies and shields us from the truth of the risk that we're actually facing. Thank you.
Thank you.
Great.
So with that, thank you very much. That was great. And with that, I'd like to introduce our 2 panelists. Jerry Theodorou is Director of the Finance, Insurance, and Trade Policy Program at R Street. Prior to joining R Street, he was Director of Insurance Research at Conning. And during his 12 years at Conning, he led insurance asset management and was highly sought after for his insights and publications on a broad range of matters impacting property and casualty insurance. Jerry holds a master's degree in political science and public policy from MIT and a bachelor's degree from Cornell University. We also are honored to have Professor Shahid Hamid, who is Professor of Finance and Chair of the Finance Department at the College of Business at Florida International University. He is also the Director of the Laboratory for Insurance, Financial and Economic Research located at the International Hurricane Center at FIU. He helped design and operates the Florida Public Hurricane Loss Model for wind loss and flood loss estimation. And so thank you both for having us. And I'd like to just start with a question for Professor Hamid, which is simply knowing the wind loss models and the wind hazard insurance market in the state of Florida as well as you do, what lessons can people seeking to understand the problems of the National Flood Insurance Program, what lessons can we draw from how the wind hazard insurance market is run in the state of Florida?
Well, there's certainly a lot of subsidy. I found that the median premium for a wind hazard for homeowner policy in Miami-Dade County, if you take the top 20 insurance companies, about $13,500 for a 1992 house that is not mitigated. And if you mitigate it, it goes down to $6,500. That's a substantial discount. And if you build it up to the latest building code, it's $5,500. So that's a huge premium. On the other hand, the average premium for flood is less than $700. And I'm talking about $300,000 for the wind and $250,000 is the cap for flood. So the subsidy is substantial. And when it comes to flood claims, there's no such thing as small claims. It's usually substantial claims. I mean, in the case of Harvey, we're talking about $100,000 per claim, roughly. So bottom line is that the subsidy is huge. The second thing is that as far as the risk is concerned, the risk is significant, obviously. And the problem is that in order to figure out what the fair, actuarially sound pricing is, you have to be able to estimate the risk precisely. You got to figure out what the losses are going to be through some sort of model or simulations and so on. And one of the problems we have is that the data that we get to estimate that risk is not really that great. For example, I run the Florida Public Hurricane Loss Model. I can run the model with some minimum amount of data that on location, on coverage, amount of coverage, deductible, on year built, which is a proxy for the quality of the construction and the building code and so on. But in order to get really good estimate, I need better data. I need to know whether you have a hip roof or gable roof. Hip roof performs better. Whether what sort of roof-to-wall connection there is, or in the case of flood, what kind of roof to floor connection do you, or slab connection that you have. So these type of data are not available, and for models to give a precise sort of estimate or better estimate, insurance companies need to collect better data on the homes and so on that they cover. The third thing I would say is, and that's kind of a broad, observation, that we really have no business having wooden roofs in hurricane-prone areas. We need to start thinking about shifting to concrete roofs, and you can design concrete roofs which are sloped, which look like barrel tiles and so on. Because what we have found through our modeling is that one of the biggest source of risk for wind is really the roof-to-wall connection, and the roof-to-wall connection is pretty weak, regardless of whether you're using straps or clips and so on. And we have to really think of really changing our, I mean, wooden roofs are architecturally beautiful, the slope, they look nice, but we really have to think about really redesigning the houses. Thank you.
Thank you, Professor Hamid. So let me just ask a quick follow-up on that. When you say that we need better data, what can we do to get better data, and what can we do to better analyze the data?
Well, I mean, the insurance companies collect data. So all they have to do is essentially, when they're insuring a policy, is to sort of collect data on things like whether the house has a hip roof or gable roof, or what sort of nails they're using, what sort of, for example, whether using shingles or tiles, what sort of roof-to-wall connection do I have, straps, toenail, or clips, things like that. Those details, 1 story, 2 story, even data such as whether it's masonry or frame. These really improve our estimates, at the individual house level, and if you aggregate it at the portfolio level.
Great, thank you.
And insurance companies can collect that data. It's they'll have to do an inspection basically of the house, or most houses, in order to get the mitigation discounts, are inspected. And that data should be basically incorporated in the exposure set that the insurance companies provide.
Now, but the same is the same true on the flood insurance side? Because on the flood insurance side,
flood insurance.
Yeah, on the flood insurance side, my understanding is that mitigation measures don't bring down premiums, and that the data is not nearly.
No, because the subsidy is so much that there's no point in giving any discount. It's already, discounted substantially. There is really not much room for further discounts for mitigation. So, I mean, I live 20 miles inland, and I pay $6,500 for homeowner insurance, and I pay $500 for flood insurance. And I don't think there is really much leeway in my case to get a discount. And this is after the mitigation discount that I get $6,500. I'm paying $6,500.
Great.
Now, as far as the data in the flood is concerned, Nfip data is not good. For instance, the claims data that I have examined, or we have examined, my team, we found that what the flood insurance is saying is that about 50+% of the claims are due to inland flooding, more than 50%, 55%, and so on, and 46% of the losses. But when we really cleaned up the data and we did investigation, we found that actually inland flood causes only 36% of the losses, and substantially lower number of claims. So we have to really redo the data that Nfip provided. Plus, we found one of the most important factors when it comes to flood is elevation, and their data, is not I would say, very, very accurate. There are a lot of locations where we did Google mapping. We looked at the LiDAR data, and we found out there was actually a lot of errors.
Thank you. Jerry, one question that we have, if we go to a more market-based model for the flood insurance program, is obviously that insurance rates may rise substantially. We've seen reports in the Miami Herald in the last couple of months that if flood insurance rates are allowed to rise, they could be 300 or 400% higher than they are today for hundreds of thousands of Floridians. What is the exposure of property owners and especially vulnerable communities to price rises if we do let the insurance follow a more market-based model? And how do we help protect those people?
Yeah, well, thanks, Mario, and thanks for having me. We heard that the rates are artificially low because of the factors discussed by yourself and by Philip. We've got the subsidies, we've got the grandfathered rates, we've got Dr. Hamid just telling us how low the flood premium is. So going back to your comment before, we don't want to be overpriced. At the same time, we don't want to be underpriced, but for a market-based approach, we should be right priced. So how do we do that? Dr. Hamid also commented that the loss data that NFIP has needs to be cleaned up, and this is key. And it's good that he's done the job there, because insurers need to have good loss data in order to come up with loss costs, which are the expected losses based on the experience. We've had decades of experience, so we need to use loss data to come up with the right rates, the risk-adjusted rates. So really the question is, first, how do we get the private market to come back in? Because the way it is working now, NFIP is not working economically, right? It's got premiums about $3.7 billion in revenues, but it's carrying $20.5 billion in debt. It had $16 billion of debt that was forgiven by the Treasury. So if you think about $36 billion in debt against about 3.5 in revenues, you got 10 times the amount of debt. So this is unsustainable. So how do we get the private market to come in and do something which is more reasonable? Well, I mean, I think of an example. We had it in California about 20 years ago in the workers' compensation market, when losses were rising because the medical costs were going up and benefits were going up in workers' compensation. So private insurance companies left California because it was a money-losing proposition, and the state set up a state fund, a workers' compensation state fund, to come in, the State Compensation Fund of California, and was making workers' compensation insurance available at the right rates, and its goal was to stabilize the market, which it did. And after the market was stabilized, private carriers returned to California, and the State Insurance Compensation Fund of California reduced its presence in the market. At one point, it was writing half of the business in the state, and now it's about 10%. So it was a temporary sort of a mechanism, whereas NFIP has become permanent. As you're suggesting, I didn't see that article in the Miami Herald, but it's appropriate probably that some of the properties will have 300% rate increases, and especially the types of properties, the second residences that are coastal, that are high valued properties, and really there's no reason to have those kinds of subsidies. So I would say that the return to private providers is appropriate, and this is something we should work toward.
Well, but again, how do we protect the people that might be affected? We had, I remember watching up close. I was in the government, taking a close look at the problems that residents of disadvantaged communities, low-income communities in Houston had in the years after Hurricane Harvey and all of that flooding. And what can we do to, a lot of those people were left without coverage because they weren't maintaining coverage to start with. What can we do to help those vulnerable communities?
Well, on a macro level, we've already talked about some of the mitigation rating uh, approach, which will be introduced in October of this year, risk rating 2.0, indicates that there actually will be reductions for many of the inland properties in some of the poorer areas of the country, as opposed to the coastal areas with the high valued homes. You talked about the pumps and about the elevation, but for the long term, we need to think about a solution that's more durable. And here, I'd like to pick up on coastal resilience and other forms of resilience. And again, I'll pick an example of where it was done and where it was done successfully, so that we can avoid this kind of revolving door problem that we're carrying. And here I think of the Netherlands, all right? The Netherlands, the low countries. In the Netherlands, where more than half of the country is below sea level, they suffered from flooding for many centuries. 1953 was the last major flood, after which the country introduced a program to build barriers, dams, dikes, levees, and surge barriers on the coast. And since there was at a cost of about $5 billion, so there was a cost there. This was a nationally run program, and the Netherlands has not had a problem with flooding since 1953, because they took measures that would permanently shore up the country and to prevent this. So this is a larger term solution, and I think this is something that can be thought about now that we are entering the age of, or the time of talking about infrastructure. So on a macro level, I would look at the Dutch example to protect homeowners who are vulnerable. And also there's an executive order that was introduced in 2015, which had incentives for or prohibitions for not building in floodplains. And that was actually withdrawn by the Trump administration in 2017. And there's an initiative now to reintroduce this executive order to prevent building in flood-prone areas, so that we don't get some of some excesses which have happened with what we call repetitive lost properties. I mean, there was a paper by the Pew Charitable Trusts that talked about a $69,000 home in Mississippi that was flooded 34 times in 32 years, resulting in $663,000 in Nfip claim payments. So we don't want to have this kind of situation either, I think.
So thank you for that. Now, I'll just point out that unfortunately, so the Dutch model is a good one in terms of policy, the general policy proposition of doing resilience and adaptation measures, mitigation measures at a regional and local level. Unfortunately, in the case of Florida, we can't rely on that model for much more than that, because in Florida, the bedrock is limestone, which is extremely porous. And so when you're threatened with a combination of coastal subsidence and sea level rise, those kinds of dikes and levees are not going to help, because the water is going to be rising all around us. But there are programs under the rubric of the National Mitigation Framework run out of that's supervised by the Resiliency Directorate of the National Security Council staff. These are the FEMA programs and Department of Homeland Security programs that have developed resilient community initiatives, just on the with the insight that a disaster preparedness is as important as disaster recovery, and hopefully those programs will be expanding in the years ahead. So just wanted to ask you both, what kinds of other resiliency measures do you think should be supported by the federal programs run under FEMA for the support of resilient communities?
So in the case of flood, some sort of program to elevate the homes, especially in the coastal region, is important, because ultimately, if you have for the existing homes, probably the best solution would be to elevate them, but it's a significant cost, and individual homeowners may not be inclined. But if the community as a whole gets a grant to help elevate the homes, that would be helpful. In the case of
Oh, go. No, please go ahead.
In the case of wind, as I have said, really the solution is basically a wholesale rethinking of how we build our homes, and that's something, I mean, obviously the homeowners have to buy into that. For example, in the 90s, when I was buying a house, they were offering for $5,000 extra a safe room, which had a slab on top and had concrete walls, and the builders told me that they couldn't sell it. People are not willing to pay even $5,000 extra for that safe room. So what we need to do is come up with, for example, better roofs that are as cheap as wooden roofs. And I think that's, the roof itself, the way we construct the roof, is going to make a dramatic difference. If you look at even Cuba, Havana, they have concrete roofs and so on. They don't suffer as much structural damage. They have other type of damages. Of course, they have a lot of houses which are not concrete, and they're going to be vulnerable. But that is, in the long run, the way to go.
I know, adding to that, that in Puerto Rico, my part of my family lives in Puerto Rico, and I grew up there. There hasn't been a wooden house built in Puerto Rico in 30 or 40 years. And so even when Hurricane Maria hit, which I think was the most powerful hurricane ever to score a direct hit on such a densely populated area, I am shudder to think what would have happened if those houses had been even up to code according to the Florida code. As you said, all of those houses in Puerto Rico, except for the very old ones, are all concrete slab, and there's even a Category 5 hurricane isn't going to damage those structures. So now, what you're in the neighborhood where I live here in Surfside, Florida, a couple of blocks from the beach. The flood insurance is significantly higher than somewhat inland. I know that a typical house here, just a 2 or 3 bedroom house here, could be paying $3,000 a year or $4,000 a year in flood insurance. So the flood insurance premiums rise significantly. They will start to become, it will start to rival the total of the homeowner's insurance. And that is going to start to depress property prices sooner or later. So what can we, to the extent that those flood insurance premiums are substantial, and that we engage in a significant mitigation of that flood risk by, for example, elevating the homes, which I know that the Mayor Burkett of Surfside has been preaching till the cows come home or till the dolphins come home about the need to elevate these houses. Is there any way to lower premiums on the basis of mitigation measures, such as raising the houses under the current program, or would that need a statutory fix?
So go ahead.
Go ahead. No, go ahead.
Yeah, the mechanics of it, really, I can't comment on it. I don't think it's appropriate for the U.S. Congress to be running an insurance company. That's not the expertise of the of the Congress. And considering how, NFIP has been extended on the basis of short-term extensions, I think there were 16 in just the last 3 years, which is kind of a clunky approach to managing this important program. But there should be certainly credits given for appropriate mitigation measures that are taken. This is standard insurance company practice. You have a base rate against which are applied debits and credits depending on positive or negative factors that either exacerbate or mitigate risk. Certainly if there's measures that are taken to minimize risk, then the credits are given and then the premium is less. This is encouraging proper behavior. We don't want to disincentivize or to encourage behavior by sending inappropriate price signals, going back to Philip's point. So absolutely, it should be the way that it's done with debits and credits.
Great. So that's a good segue to introduce a couple of questions from experts in this area for both of you, Professor Hamid and Jerry. One of them is Matthew Eby, who's the founder and executive director of First Street. First Street Foundation is a nonprofit research and technology group that's completely focused on the problem of flood risk in the United States. So Matt, would you like to take it away?
Yeah, thanks so much. And good to see you guys. I thought I would start off by showing the work that we're creating with something called Flood Factor, which shows the risk at a property level and some of the economic data behind it that then ladders to my question overall and hits on a lot of the questions that Mario, you were just talking about with affordability and longer term price points. So the data that we create, we've created a nationally available property specific flood model that's forecasted in the future based on the Intergovernmental Panel on Climate Change's RCP curves. And I'll just go to Norfolk on here. We have partnerships with Realtor.com or Redfin to show our data for homes that have risk. So I'll just go to Norfolk quickly because they have a lot of individual flood risk. You can see any of the properties here. If we just click on one, we'll end up with a listing. And what we actually show is our data through something called Flood Factor. And any individual looking at a home can now see what their flood risk is from our model. We show that it's a severe flood factor, that there's a 1% chance of 2 feet of water reaching the building this year. And you can see the full building details. And because we forecast not just the annual risk, which is the basis of flood insurance, as we all know, we look at cumulative risk over time for the homeowner and how that's increasing based on higher sea levels, warmer sea surface temperatures, atmospheric temperatures, et cetera. So we see that it's in a FEMA zone AE, a special flood hazard area, but that gives us the idea of what risk is currently. And it doesn't show us what the risk is over time. So if we go to Flood Factor itself, we've actually done the work to generate average annual losses for every home in the country. This home with that severe flood factor, we can show the likelihood of flooding over a duration of time based on the depth of water. So it has over a 15-year period, a 94% chance of flooding with any water to the building. You can change that to 6 inches, you can change that to 12 inches. But it shows the likelihood of that level of flooding during that period of time. The interesting part that we just launched and what's relevant here is that we also have calculated the average annual loss for the property based on all of the probabilities of flooding, depths of water to the building, first floor elevation, the building value, and leveraging the Army Corps of Engineers depth damage curves to actually do those calculations. You can see the building assumptions that we have from our data, where it's 3 feet off the ground. The property value, it's 2 stories. If we just flip back to what the property looked like, it's 2 stories, it's 3 feet off the ground. You can see from the steps going up, and they have it for sale for $500,000. So that's what our basis is off of with our model. But the important part is that you see it's $3,400 damage this year is anticipated, and that increases to $9,600 over the next 30 years, which shows the dramatic increase that climate is going to have from sea level rise and precipitation patterns and all the things I had mentioned. So we're looking at almost a 3x increase for this property, where if you just looked at it from a flood insurance perspective, you would never be told that your premium this year is not going to be the same next year, and so on and so forth, during the ownership period of the home when you're looking to purchase it. So my question overall is, knowing that this is going to happen and our industry looks at the annualized risk and prices that risk associated with it and has that premium, and that's what the NFIP new risk rating 2.0 is supposed to do, and it's supposed to be held to actuarially sound methods, which means if the risk continues to rise, they will continue to raise the prices. How do we communicate this aside from tools like this? But what do we do to talk about this affordability issue, Mario, that you were just mentioning as well? How do we actually say, our industry looks at risk and we'll be okay because every single time we look at the annual risk, we'll price it accordingly and move up. But there's people with actual homes that will be devalued in the future as we go from this, just because of the risk that's there and inherent there, but is not being communicated to them.
And so I think that would be a great question for Jerry to start, but let me add a wrinkle to it if I can. The prognostications of sea level rise on which your models are based are still have a very wide range in terms of all of the scientific studies. The same is true with respect to temperature rise. Equilibrium climate sensitivity, even according to the IPCC, could be as low as 1 degree Celsius for a doubling of carbon dioxide. It could be as high as 3 or 4 degrees Celsius. But that means that covers the entire range, from not much effect from increasing carbon dioxide to catastrophic effect on temperatures. And so is the insurance, how do we talk about that risk so that homeowners are aware of it, as you've asked, Matt, but also how do we talk about the uncertainty that remains and the fact that insurance companies in the private market would be charging for worst case scenarios that may turn out to be not founded by a better understanding of the climate models?
Right. Well, thanks, Matthew and Mario. There's a lot to unpack there. The communication issue is not one I'll address immediately, but let's recall what is the function of insurance? What is the function of an insurance provider? It's matching capital to risk, bringing capital in the form of insurance company reserves. Insurers are capitalized. They've got money that's set aside for paying claims, present and future. And risk is refers to the probability of a loss, and risk is quantified on the basis of data. We've already talked about the data that the NFIP has, which is not very good, and what Matthew's introducing with his data is something which shows really what the risk is on a granular level, and it can help an insurance provider to come up with a more accurately calibrated premium. You think about progressive insurance, automobile insurer, that is probably the automobile insurer that uses data on a granular level better than almost any other company. They really are in the business of data, and indeed insurance is in the business of data management. And the Matthew talked about risk rating 2.0 and introducing actuarially appropriate rates. I don't think it's happening soon, because the maximum increase is 18% for any property, and the example that Matthe just showed us, you mentioned, Matthe, I think 3x or 300% higher than the current rates. So, how do we get to the appropriate rates? Well, first, I think we should deal with some of the issues I mentioned before. The Mississippi property that had 34 flooding events in 32 years, and the cost of the house $69,000, and they paid almost $700,000 in claims. This should not continue. There should be some limits to this sort of repetitive loss phenomenon, which accounts for only about 1% of the properties that are insured by the NFIP, but they generate 30% of the claims. So this is something that hasn't been addressed and needs to be addressed. There were some incremental measures raising the premium by 5%, whereas that's really clearly not enough. And then, Mario, to your point about uncertainty, there's a difference between risk and uncertainty. Risk is something that is measurable using data, historical data. Insurers, actuaries need to have that rich data historically so that they can come up with estimated loss costs that go into the pricing in the future. But uncertainty is something that we don't know really what's going to happen. It's the sort of the oops effect. Who'd have thought that Louisiana would have five landfalling events in 1 year, or Florida in 1 year had 4 hurricanes. So this is something that insurance companies think about, but they don't price for the worst possible scenario. There's protection that's obtained for what happens at the higher end of the possibilities of sea rise and temperature rise, which you talked about. And NFIP has been doing a good job, I think, of purchasing reinsurance. A couple of years ago, they dipped their toe in the water, bought $1 million of insurance. Now they're buying towers of hundreds of millions of dollars of reinsurance, and the private investors that are feeding into insurance-linked securities, catastrophe bonds, are taking some of this risk. So they're laying off some of that uncertainty by having high levels of reinsurance, which is also going into retrocessional reinsurance, which is reinsurance of reinsurance. So the uncertainty factor is really taken off of the plate of the primary insurer. And when you do have an event that there's a shock event, that's typically something which is addressed after it happens. But they're not really pricing for the the most severe possibility.
Well, and let me ask a follow-up question about that for Matt. Matt, if we can you share your screen again and show us that listing with your module in it? Is that possible? So yeah, so how do what you said that this is in line with the IPCC, but again, the IPCC forecasts cover quite a wide range of potential sea level rise over the next 100 years. So how do you handle that sort of wide range and possible scenarios?
Yeah, our model's built off the 4.5 curve. And then within it, we sample from the 25th and the 75th percent quantile, so we can show uncertainty. So
when you
here's
say
the
4.5 curve, is that, what is the 4.5 curve?
So the RCP 4.5 curve. So you have the 8.5, and then the different representative concentration pathways of the different emission scenarios. We take a very the lower emission scenario from it, so not the aggressive or the lowest on the 2.6 curve. We look at the 4.5, and we're going out 30 years. So when you look out 30 years, within that, you can actually see that the curves are relatively aligned. It's when you get to 2100 that you see these great disparities. So within 4.5, we're actually forecasting right into the middle of the scenarios. And then within that, we look at uncertainty within that. So on the 0.2% to 1 in 500 this year, the median is 3.4 feet. Under the low scenario, 3.4, and to the high is 3.6. So you can see that, and then the estimated damage amounts from that within the global climate ensemble are what we represent here through the average annual loss through the depth damage curves. And then you can see that in 15 years, it's 4.7 feet. And then in 30 years, it's 5.9 feet, but you still have the uncertainty within that. On the 1% side, it's 3.3 feet to 5.7 feet. So as you're talking about that uncertainty band in 30 years from now, but then you can see this year to 30 years. And then more importantly, on the lower layers, so the 1 in 5, we have 0.4 feet of flooding and 30 years, but this year there's not any water that reaches the building from our model within this. So it goes from, but there's still that uncertainty layer this year. So it could be 0 feet to 0.1 feet. So there's $0 in damage to $20,000 in damage under that 1% or 20% scenario. So to your point, as an insurance company looking at that band, where do you put the price point? But that's how we handle the uncertainty within the global climate ensembles based on the selected RCP curve of 4.5.
Great. Well, thank you very much. Professor Hamid, did you have anything to add to the discussion in the last few minutes before we go?
Yeah, I would say that to your, I think you were saying something about the insurance companies are charging based on the worst case scenario. That's where the regulators come in. The regulators ensure that they're actually charging based on the annual average loss. They also ensure that for solvency purposes that they look at the PML and they sort of stipulate reserves that the insurance companies have to have or reinsurance they have to have based on the PML at 100-year return, to take care of 100-year return sort of losses and things like that. So, and as far as the NFIP coverage is concerned, I mean, in the state of Florida, we have 9.2 million houses and only 18.75% have insurance. 1.72 million properties have insurance, flood insurance, that is. Whereas, in the case of homeowner wind, of course, the coverage is over 90%, about 88%. So this is the dilemma. In some sense, if you look at Harvey, NFIP paid out $8.8 billion, and in case of Irma, it was 16 billion. I'm sorry, Katrina. But if Houston was never really in a high risk zone. I mean, it was basically low to moderate risk zone, and still you had 50-inch of rainfall. And the coverage in Houston was 14%. So in some sense, for NFIP, it was a blessing that the coverage was only 14%. Otherwise, the amount they would have to pay at a subsidized rate would have been substantial. So even though the rates are low, but the coverages are low, and that has kind of and still NFIP has a $25 billion deficit. And this is a dilemma, I think, for the government also, because they have to pay through FEMA one way or the other. Either they pay it out through NFIP or through subsidized loans or grants and so on to rebuild the community. So if we move towards actuarially sound pricing, we're going to have lower coverage. And a lot of, for example, homeowners may decide not to, to forego their coverage. And then we are back to square one in terms of insurance and who pays for the coverage and so on. And, as it is, right, in the state of Florida, we have had tens of thousands of lawsuits about who paid for, in the case of Ivan and other hurricanes, because homeowners who didn't have coverage, flood coverage, they basically claimed, the losses, the water damage was because of some kind of breach through the roof or window intrusion and all that, and that is covered by homeowner policy, and thousands and thousands, hundreds of thousands of lawsuits were filed as to what really caused the damage. Was the accumulation of water and so on. So this is this is a problem, and in the long run, really, I mean, essentially, the federal government is the reinsurer for NFIP, but in the long run, as you go through private sort of insurance, you will need to have reinsurance, or you will need the capital market, as Jerry mentioned, take some of the risk. And NFIP, for example, has issued about $3 billion worth of bonds, catastrophe bonds. And in fact, they had in 2021, this year, they issued about $1.1 billion. They paid about $196 million in premium, and they've decided to go that way. Capital market, capital market can absorb $100 billion swing loss in one day alone. So if you really want to spread the risk, that's the way you will have to go in the long run. You'll have to bring in reinsurers are not enough. You have to bring in the capital market. And if you're able to design and sell the securities and able to spread the risk better, private insurance companies will enter the market. Law of large number dictates that you basically will have lower premium than you would otherwise. So there are some long-term solutions. We have to work at it.
Thank you very much. And that's a good opportunity to plug the Environmental Finance and Risk Management program at Florida International University, which is designed precisely to help develop some of those financial instruments that Professor Hamid just talked about that will allow us to better model for and spread the risk. So with that, I'd like to go to Rodrick Scott, who is the chairman of the board of the Flood Mitigation Insurance Association. Rodrick, thank you for being with us. Please take a minute to talk about your work and pose a question to the panelists.
Yes, thank you very much, Mario. Actually, it's the Flood Mitigation Industry Association. I guess we got it mistyped in there. We actually are the industry that creates the products that then go onto the buildings or elevate the buildings to keep them from flooding. We reduce flood risk and therefore flood insurance and flood insurance losses, flood insurance rates and flood insurance losses. I live in a historic coastal community in Louisiana, north shore of Lake Pontchartrain, across from New Orleans. No levees, 5-foot seawall. Had 4 floods last summer, and within a week of each flood, we were back in business because my community is 86% elevated now. And the 10 buildings left on the ground, you can't sell. So we're well ahead of the rest of the nation's coastal areas as far as the experience of the retrofit and the mitigation. Just to give you some perspective, our industry estimates, the problem is nobody's counted these buildings. It's a huge failure in the planning world and in local government and national government. We desperately need an inventory of these oldest or pre-firm, pre-flood map buildings in the flood zones in our communities, because we're going to have to retrofit them. There is no solution other than elevation, dry flood proofing, removal of the structures from the flood zone, which puts an impact on your property tax revenues. But on the other side of that, we're in the middle of the NFIP removal of subsidies right now. We're halfway through this removal of subsidized rates for these estimated 3 to 4 million residual older buildings that are in our flood zone. So our industry estimates about a $600 billion retrofit that's coming, that has to be done, because the insurance rates will kill the values of the buildings. That will then kill the revenues that are so critical for revenue bonding for schools. 50 cents out of every tax dollar goes to a school, and services and keeping those sewers running as the water continues to come. So it's an interim deal. Our nation will ultimately have to move back from the ocean. Our industry is firmly aware of that. But right now we've got to quit flooding our buildings, and we know how to fix them. The problem is there's been no way to finance it. It is not inexpensive, and it's very difficult and hard work. And the banks estimate that these 3 or 4 million residual buildings have an asset value of 1.5 trillion. So our retrofit is just about half of the value of the properties. And that'll get you 2 more mortgages at the shore before we have to start relocating buildings, because the ocean is not going down. The ice isn't going to quit melting. The globe is warming, and we either adapt or we lose. And I'm not a good loser. So we're going to adapt. So our question is, how do we finance this? Because there's federal banking regulations limit the amount of money banks can loan to property owners for these assets. It's called the loan to value ratio, 80% of the property's value. After that, they can't loan you any money. And this takes about the value of the improvement on the property, or the structure's value is generally a loose framework that we can work from to talk about how much this is going to cost. So essentially, we got to invest in this generation, work for 2 more mortgages at the shore, and then start. My kids are going to have to start planning how we're going to start that relocation. So because we don't want to wait until the end, we don't want to destroy property values. So let's look at Florida, for example, just real quick, and I'll ask the question. We estimate Florida is #1 in this inventory of old buildings because of the way it was built out pre-World War II, and then the explosion of lagoon systems and older concrete block buildings after World War II. We think Florida has 600,000 of these buildings and no plan. So when Miami Beach tells us that they have 15,000 buildings and 9,400 of them are pre-flood map, or St. Petersburg tells us they have 20,000 of these buildings in their government unit area, their boundary, and Key West says 75% of their buildings are these older buildings. So I have a building owner on the lakefront in the velocity zone, runs a restaurant. Last week we were teaching a 2-lane historic preservation class this semester on how to estimate these projects, because we've got to get to the assessment phase. We know they're vulnerable. Okay, they're vulnerable. Let's see what it's going to cost to fix. And the owner came out and said, 10 years ago, I paid $2,500 a year for this property. And last year I flooded 4 times and insurance paid for it. And I just got my bill for next year and it's $25,000. And the owner said, I asked the insurance agent, how far is it going to go ultimately? Because he has 5 more years on this annual increase of 25%. And the insurance agent said 47.5. That will be an empty building, no one employed, no one serving drinks or food. And you can't serve enough drinks and food in a restaurant to support just the flood insurance alone. So we've got a retrofit. My town's 80% elevated and over 80%, and we're never looking back, and we're not going to live on the ground anymore. And Florida hasn't elevated but maybe 1,000 buildings out of 600,000. So they're way far behind, and we got to fix that. So how do we finance this? Is it in fact this new Storm Act, the revolving loan that our industry has been trying desperately to get in place for property owners to be able to borrow the money outside of the mortgage envelope, attach it to the taxes, pay it off over a 30-year period, buy and sell the property with it? So I'd like your take, if any of you have studied this new Storm Act and the fact that the banks have committed several $100 billion to this program if we could get it passed, and now we've got it passed. So we're pretty excited. So I'd like to talk about financing the reduction of this risk as the critical component to lowering our damages and costs of these ever increasing flood events. So thank you.
Thank you, Rodrick. Thank you very much for that great question. Jerry and Professor Hamid, if you want to take a minute or two to discuss that really quickly, and then we'll, in the time we have left, would love to open it up to questions from the audience.
Yeah, thanks, Mary. I'll take the first crack. But first, I'd like to compliment you for bringing together Matthe and Rodrick, because I think that they address what really was intended with the introduction of the NFIP in 1968 by statute. There were 2 purposes. Let's go back to the statute. What were the purposes of the NFIP? First, to provide access to primary flood insurance. And I think that the modeling work that Matthe has introduced is something which certainly was not available decades ago. And models such as Mathe's flood factor, what Professor Hamid is developing over there at your university, this will help us to provide flood insurance appropriately. And then the second purpose is to mitigate and to reduce the nation's flood risk. And Rodrick is a great example of a town that is elevated and is reducing flood risk and flood proofing homes as much as possible. So those are the two purposes of the NFIP. And I'm glad to see that they're both being addressed in this program this morning. But instead of answering the question directly, I'd like to throw it back to you, Rodrick. How did your community finance 86% elevation? Because obviously you've done something right there in your community, but how did your community do that? You're on mute.
In the queue and unmuted while you were asking. Well, we are in Hurricane Alley. Our community must have had 100 hurricanes since the white man settled the area. Basically, it was done through the floodplain ordinance. My wife was the director of planning during this retrofit, and she just retired after 35 years a couple of weeks ago. So she's really the head of it all. They would not let them rebuild or get a permit unless they elevated. And that is holding to that ordinance. And that is the most egregiously violated part of our flood program. Is when it floods, the political pressure is enormous. And usually the politicians direct the building departments to overlook it or look the other way. In fact, when I rebuilt them for 30 or 40 years, the first men who taught me how to rebuild flood buildings said, go to the tax rolls and see what the building value is worth and come in at 49% of the value of the building, and you're good to go. You can come back 5 or 6 times and rebuild it. We can't do that anymore. So our community held to its ordinance. We also have a very high net worth in our first couple of blocks from the lakefront, very valuable properties. A lot of them historic, like this one built behind me, 1840s. They basically privately funded. 80% of our elevations were privately funded because they restricted the people from rebuilding until they included the project in their rebuilding. And so, people's rates have gone from $10,000 a year in the B zone down to $1,500, $2,000 a year, and that's survivable for now. NFIP 2.0 is going to change those computations a little bit, but when you're 12 feet off the ground, it's going to take a heck of a storm to get to you. We can usually maintain almost anything except for the Cat 5s.
Right. Well, if that solution could be telescoped elsewhere, that would be great. I'll yield the balance here.
Professor Hamid, did you have anything in response to Rodrick's question? You're on mute.
Yeah. Excuse me. Yeah. When it comes to financing these mitigation measures, if you look at the cost-benefit ratio on some of the studies that have been done of these mitigation measures, I'm talking more about wind rather than flood, it doesn't really pan out in terms of given that you already have discounts and everything, unless you bring in life and limb, okay, the benefit of saving life and limb, and then the ratio goes over 1 in terms of benefit, cost and benefit. So if, strictly speaking, if banks are looking at what the benefit would be, a reduction in losses would be, and so on, from mitigation, it's often, from an economic point of view, it may not be feasible.
Now, would that be true in a more market-based system, or do you mean under?
Well, no, I'm talking about the wind. Yeah, I'm talking about the wind alone. For example, you can get a substantial, almost 40%, 50% reduction if you use, put in shutters and you change your roof-to-wall connection. In the case of wind, you use a different roof and so on. It's the point is that we have to develop technology which are cheaper, and that's going on right now. That the cheaper mitigation techniques and so on, and it's coming along. And if that happens, I think the mitigation will become, if it becomes substantially cheaper, then the loss, it can be proven that the loss reduction due to the mitigations are substantial, then I think the banks will come around and start loaning money for that. But that's not going to happen unless we have better technology.
Great, thank you. Well, thanks to all the panelists so far. With that, I'd like to open it up to questions. You can either drop a question in the chat box, or at this point, don't all go at once, but at this point, feel free to unmute yourself and try to jump in. Well, hearing none, I'm happy to ask another question. Going to Rodrick, how much is it, what are we talking about in terms of the cost of elevating a house? And let's say that you have a typical house. Now, in Florida, there are houses that are on slab foundations, and there are houses that are on pylons to start with. How much of a difference does that make? And what are the potential costs here, say for a typical home of $350,000? You're on mute.
Should just leave it off of on mute. Thanks, Mario, for the question, and it's a question I get at every single presentation that I'm involved in. And our answer as an industry is that there's some base level budget cost type situations, but just as you and I are human with a head and arms and legs that we're fortunate enough to have, but we're different, and every house is different, and every building is different and unique. Similarities, but unique. So your lowest cost per square foot is in the wood frame structures on slab or on crawl space. The next price point is for the slab separation, which can be a wood frame or concrete block structure separated from its slab. The walls brought up if it's only a 3 or 4 foot elevation, or on open legs if it's going to be a deep water zone, V-zone type construction, open foundation we call it. And then you have to create a wood floor system in it where it sat on the slab before. If it had a wood floor system in it, you can elevate the concrete block house with the wood floor system still there, and you just build up the new foundation to meet that new elevation. And most of the houses and structures in Florida are the concrete block. And then the most expensive is what we do here in the Gulf, where it's a monolithic slab on pilings, where we actually excavate under the slab, elevate the entire slab and the whole structure. And we've got them 14, 15 feet in the air. And that's in Louisiana, non-union areas of the Gulf South, you're probably at $150 to $170 a square foot of foundation total for that, and you're talking $300 a square foot to build new at the coast. And remember, you only have 2 more mortgage cycles in most of these places, so why would you tear down a building and build something brand new? Ultimately, we're going to have to relocate that. Why don't we just get as much use out of these structures as we can, salvage the ones we can as we relocate, as our children relocate, not me. I'm 64 with 7 grandkids, so I'm just going to get them as tough as I can. We're not going to build our way new out of this problem. And the other big issue is that NFIP 2.0 is going to eliminate the grandfathered buildings. That's the one thing in the bigger waters that they couldn't get pushed through, and got extreme pushback from the banks and the politicians and folks like that. So we think that that's going to bring in 30 million more buildings. So those are the first flood map buildings, which are not going to make it in the era of sea level rise. They were built to those paper maps and a whole different concept of risk. And so there's going to be an enormous retrofit of that. Literally, we see this as the moonshot program for our nation for climate change adaptation, is to get these buildings so they don't flood, because flooding is going to happen. And good luck keeping floods out of the Florida coastline, because it's low and it's there, and we're not the Netherlands. So you're just going to have to adapt our buildings to survive and stay in these places. And so it's about half of building new is the cost of this retrofit.
Great, thank you. So with that, we have a question from Maureen Thompson. Maureen, if you can unmute yourself and go ahead. Thank you.
Hi, first I'd like to thank the panel. This has been a very interesting presentation. I'm actually a history candidate. I'm a PhD candidate in the history department at FIU. And I'm originally from Philadelphia, and my family had a vacation home in Ocean City, New Jersey that was affected by Hurricane Sandy. The insurance companies came back and told everyone on our block that we would have to elevate our homes in order to be funded in the future for insurance purposes, or the insurance rate would go up astronomically. So my mother, who has arthritis, there's no way she can climb, stairs that high. And my father-in-law was wheelchair bound at the time. So my question to you is, how is it possible to rebuild properties that are coastal, that can, accommodate people with physical disabilities? Is that possible?
Great question, Maureen. Thank you. Yes. I tell people the story with those concerns that we're not just going to build gigantic ramps to all these houses. Innovation is going to help us. And 10 years ago, when we first started this massive elevations, Louisiana's at 36,000 homes now elevated, and they all have lifts on them or elevators, one or the other. The very high value homes go ahead and invest in an elevator, and the others all do lifts, which are essentially a cargo lift by law, but are used as an elevator as well. And so you had 4 manufacturers of these 10 years ago, and now you have well over a dozen, and they come as expensive as $30,000 with air conditioning and closed in. They're made out of marine grade aluminum. They now have solar panels and DC motors that are mounted on the top. So what's the first thing that goes out in a storm is your power, and then you're stranded because you have mobility issues. These lifts continue to work because the first thing that happens after a storm is that blazing hot, humid sun comes out and really makes the recovery even more difficult, at least in the Gulf areas. So all of that is being addressed through innovation, and if it's a grant program, a federal grant program for the elevation, all you have to have is a doctor's note, and that lift is included in the grant, which is the right thing to do. I'm all about disability access.
Great, thank you. Well, with that, I'd like to thank the panelists and thank everybody who came to participate. I see no further questions, but I'll give, while I try to wrap up a little bit, I will give folks a minute to alert me that they do have a question. While I look at that, I think we've got a lot of work to do, obviously, in the years ahead as a nation to try to address the problems that we've highlighted today. Hopefully, these are clouds with silver linings, and what will come out of it is more resilient communities and more affordable and safer housing. And so what we will be looking forward to at the Environmental Finance and Risk Management Program, working closely again with FIU in Washington, DC, is reaching out to folks like those who have participated on this call, reaching out to folks on the Hill and in federal agencies and in state government to try to explore some of the solutions that we can bring to bear to these problems. And hopefully, from the innovations that Professor Hamid was talking about and that Rodrick has alluded to some of the more rational market-based assessments and analyses, both of the actual flood risk and of the scientific data and of the financial situation facing our communities. So with that, thank you very, very much. And I think that we have a video coming up, which I guess we can roll starting right now. Thank you.
At FIU, we own the challenges of our time by transforming public investments into results that make an impact. Our country's scientific and policy leaders know FIU's breakthroughs are transforming Miami and the world. Our teachers inspire America's future scientists and engineers and use our tools to realize the full potential of our children and families. The country counts on us to monitor the health of the Everglades and Biscayne Bay and ensure America's coastal communities are resilient and safe from disasters. But we mobilize on our own when Florida's treasures are threatened. The Pentagon invests in us for future generation antennas and secure communications. And our engineers are restoring sensation and quality of life to those who have lost limbs, like our returning veterans. As we seek to reduce preventable disease and disorders of the brain, our scientists are leading dialogue and action. An investment in FIU is an investment in real solutions. Leaders in Tallahassee and Washington are recognizing that we drive policy. We are as real as it gets, and what real does makes a real impact.